and thank you for joining us for today's webinar, Unrelated Business Income, Navigating the Changing Landscape. My name is Danette Scheip, and I will be your moderator for this webinar. Before we get started with our speakers, I'd like to go through a couple of housekeeping items. First, we encourage you to ask questions throughout the presentation. You'll see a webinar pane that you can use to enter your questions. Just click the red button to send the question to our presenters. They will answer the questions as time follows at the end of the presentation. Secondly, we want to make sure that you have excellent audio quality, so please select the appropriate setting. If you're using a telephone, please click on the Use Telephone Audio Mode, or if you're listening through your computer, then please click on the Use Mic and Speakers option. Now let's review the requirements for those of you who are interested in CE for your participation in this webinar. To qualify for California CE, you must use a personal computer, no PDAs, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions and complete the evaluation survey at the end of the webinar. Now let's meet our presenters. First, we have Lynn Henley, who is a tax partner at Armanino. During her 18 years of experience in public accounting, Lynn has provided consulting and compliance services to a variety of tax-exempt organizations, including public charities, private foundations, supporting organizations, social welfare organizations, labor unions, social clubs, and business leagues. We also have Barbara Cyphers, who is a partner with Armanino for 15 years. She works in the firm's nonprofit tax niche group and also serves closely held businesses. Her recent presentations include the topics about FIN 48, Unrelated Business Income and Related Planning, the new Form 990, and compensation considerations. We also have Tammy Sukahara, who specializes in the preparation and review of nonprofit returns and consulting in this niche area. Some of her clients include the DeYoung Museum, Oakland Museum, San Francisco Goodwill, and the San Francisco SPCA. Tammy also chairs the Cal CPA nonprofit interest group of the East Bay Committee. I'll now turn it over to Barbara to review the learning objectives.
Great. Thank you, Danette. Good afternoon. We're glad you could all tune in today. Hang on to your seats because in the next hour we will help you navigate through the unrelated business income maze. And if you don't mind, what we're going to do so we can get all of this good information in the next hour, we're going to tend to abbreviate unrelated business income and refer to it as UBI. You will be reviewing case law and rulings affecting your organizations, and along the ride you will discover ways to minimize or to avoid exposure to the UBI tax. At the end of the journey, our goal is that you better understand how the income is reported and how you can plan around certain implications. To be more specific, to paint the picture, I'll give you a brief background. Lynn will pave the way and lay down the framework for us, and then we will examine certain areas in a lot more depth and go through examples and planning opportunities, and of course there will be time at the end for questions. This area can tend to be somewhat complex, and your fact patterns are often unique. You'll notice in this presentation that there are a lot of general rules. There's a lot of exception to those rules, and there's exceptions to the exceptions. So we encourage you to consult with us or your tax or legal professionals with respect to your specific issues. Now, an overview. The taxation of unrelated business income, UBI, has been part of the federal law since 1950. The law really rests on two basic concepts, the first one being activities unrelated to the tax-exempt purpose of your organization are to be segregated, and then the second concept is the net income from the UBI activities are taxed essentially in the same manner as for-profit entities. Up on the screen you'll see a quote. It comes right out of committee reports, I believe. But the purpose of the rules is to make sure an exempt organization does not commercially exploit its tax-exempt status for the purpose of unfairly competing with taxing organizations or for-profit organizations. The unrelated business income rules apply to most exempt organizations, including retirement plans, charitable, religious, and scientific organizations, private foundations, and other organizations described in 501c. Excluded from UBI reporting are government agencies, kind of no surprise, but municipal colleges and universities are subject to the UBI reporting rules. So what's interesting is that you might be thinking, well, certain organizations like churches, they don't file generally a Form 990, and also small organizations under the filing threshold may not be filing a 990, but they still could be subject to the unrelated UBI rules and have to file the form reporting that income. Since 1950, new technology and business practices have really changed the landscape. And this leads to our first stop sign or polling question. And we're not going to put you on the spot with this one, but I'm going to turn that over to Danette.
Okay, thanks, Barbara. So this first question is sort of just a survey of our audience here to help our presenters. So the question is, which of the following best describes your type of organization? You have your selections there. We'll give you a few seconds to make your selection. And just a reminder that a recording of this webinar will be available on our website within 3 business days. And if you are interested in CE credit, you do have to respond to at least 75% of our polling questions. So this one's a giveaway. All right, we'll close the polls in 5, 4, 3, 2, 1. Polling is now closed, and I will hand this back over to our presenters.
Great. Thanks, Danette. So interesting. So a quarter of the people in our audience are with educational institutions, and we should have had a couple more categories. We have 60% in other, but we'll try to use that information as we go along to hopefully reach out and meet your needs. So with that, I will give the keys to Lynn to help us continue on our journey here.
Thank you for getting us on the road, Barbara. Now we're going to head for the freeway. A little bit of background. Picture it. 1924, a small religious order in the Philippines. Most of its income comes from large real estate and securities holdings, and a small amount from the sale of wine, chocolate, and other miscellaneous items. A dispute arises between the insular collector of the Philippines, the tax collector, and the religious order. The insular collector argues that the order is not being operated exclusively for exempt purposes because a significant amount of its revenue comes from commercial sources. The dispute eventually lands in the U.S. Supreme Court as Trinidad versus Sagrada Orden. 2 things come out of Sagrada. The meaning of the word exclusively changes to all activities except an insubstantial part. And in its opinion, the Supreme Court stated that the destination of income was the ultimate test for exemption rather than the source of the revenue. So to clarify that, the court is saying that as long as the revenue is used for an exempt purpose, we don't care where it comes from. And remember, this is the old law. So fast forward through the 30s and 40s. Exempt organizations are buying and operating businesses, they're borrowing money, and they're engaging in all manner of clever strategies. One of the most egregious examples was New York University. NYU owned C.F. Muller, the nation's largest macaroni company, and a number of other businesses. Now, all of the profits were indeed distributed to the university. Under the destination of income test, this posed no problem for the exempt organization status. It did, however, pose a problem for the government, lost tax revenues, and it affected the perception of fairness in our tax system, and of course competing businesses and those concerned with the ownership of pasta did not care for the NYU ownership of the macaroni company. Because the situation was completely out of hand, legislation was included in the Revenue Act of 1950 that imposed a tax on unrelated business income. Pursuant to that act, the destination of income test became a thing of the past, and it became necessary to analyze the source of the revenue to determine if it is unrelated. So you can all thank the Revenue Act of 1950 if you're struggling with UBI. Our statutory framework. Very briefly, our tax code is huge, but it's highly organized. It's divided into chapters, and the chapters are divided into sections. We're talking today about sections 501 and 511 through 514 of subchapter F. So let's begin with section 501A. This is the section that exempts your organization from income tax. 501A reads, in part, an organization described in subsection C, that's where we get 501C, or D, or section 401A, that's qualified plans, shall be exempt from taxation. So 501A is a hit for us. But then we come along to 501B. 501B says that even if your organization is exempt, generally, to the extent provided in another part, your organization is subject to tax. One of those taxable parts includes the code section 511 through 514. Those are the UBI and debt financed income sections. So, included in 511 through 514 would sure enough be 512A. Pursuant to section 512A, except as otherwise provided, the term unrelated business taxable income means gross income from an activity that is 1, unrelated, and 2, a trade or business, and 3, regularly carried on. And remember, the activity must meet all 3 criteria to be subject to the tax. Your first step in identifying the relationship between the activity and your organization is to review the Form 1023 that your organization submitted to the IRS to request recognition of its exempt status. The 1023 will include the description of your organization and why you thought you should be exempt. So we're going to look in depth at all 3 criteria of UBI. We're going to look at the term unrelated, the term trade or business, and the term regularly carried on. But first, Danette, I think you have a second polling question.
Great. Well, thank you, Lynn. So yes, we will move on to polling question number 2. This question reads, what characteristics must an activity possess in order to be classified as unrelated business income? You have your selections A through D there. Take a look at those and make your selection. We appreciate hearing from everyone, even if you're not interested in CE. And those of you who are interested in CE, remember you do have to respond to at least 75% of our polling questions to be eligible. And if you do have any questions while the presenters are speaking, please do feel free to enter those into the chat box on your screen there. Give you guys a few more seconds here, and I'll close the polls in 5, 4, 3, 2, 1, and I will hand that back over to Lynn.
Thanks, Danette. Okay, so in our audience today, we have UBI experts. So got to turn this up a notch. We'll have the advanced class because our folks out there are just fabulous. We got 100% correct there. Okay, we're going to look at the phrase substantially related. We're going to define substantially related in order to explain unrelated. That happens a lot. You know, you define a word by what it isn't. So let's look at substantially related. In order to determine if an activity is substantially related, we need to understand the relationship between the activity in question and the accomplishment of the organization's exempt purpose. So what is my purpose, and is this activity I'm about to engage in related to that purpose. And again, remember that just raising money for the organization does not make it related. So the central question, does the conduct of the activity contribute importantly to the accomplishment of the organization's exempt purpose? And in the Treasury regulations, if you're ever reading about this, it's referred to as a substantial causal relationship. So let's say that you determine that there is a substantial causal relationship between the activity and your exempt purpose. There are still a few things to watch for. The first being size and extent. Now, this is a tricky one. So even where an activity is generally related to your exempt purpose, if it's conducted on a scale that is larger than it needs to be, the excess will still be subject to unrelated business income. So let's say you have a retail outlets. Let's say you have 20 retail outlets, and you, as part of your exempt purpose, you were going to have job training for folks that need job training. That's going to be your exempt purpose to, promote people who have skills. Okay. Now you don't need 20 outlets to train 50 people with some job skills. Now, if it's your intention that you're going to expand the job training program to 1,000 individuals, then 20 outlets would be reasonable. But if your training program is just for 50 people and you keep cycling through that number, the service is going to say, really, you're just a chain of retail outlets posing as an exempt organization. So to the extent you're just a store, you're going to be taxable on the unrelated income. And that makes sense because you're just a store like anybody else. The next item to look at is the same state rule. Now don't be confused by this. It's not about geography. And the best way to explain the same state rule is, let's say that you're a sustainable farming organization, right? You're going to teach people how to grow wheat in a sustainable way. So you're going to train farmers and help whoever it is involved to do this in a way that's going to make sense for us in the long run. Okay. If you sell the wheat that you produce, that's going to be a related activity. So the gross proceeds from the sale of the wheat won't be subject to UBI. If, however, you take that wheat and make bread, you have changed the state of the wheat. So the sale of the bread subsequently would be unrelated business income. So that's the same state rule. Dual use rule. Let's say you have a museum, and in that museum you have a large auditorium, and during the day you show educational films and have demonstrations that are related to your exempt purpose. But at night, that same auditorium transforms into a movie theater where you show great movies, but they are just commercial movies. What the service has said is that just because your facility is used during the day for the exempt purpose, that same facility at night is used for an unrelated purpose, so that use will generate unrelated business income. And then you'll see the next item there is the exploitation rule. Let's say that you're a famous heart research organization, and you have a fantastic reputation, so people want to be associated with you. And let's say that there's an equipment manufacturer, some kind of heart monitors or something of that nature. They come to you and they say, you know what, we would like to use your name as part of our sales process when we're selling our equipment. And you say, great, and you tell them how much that's going to cost them to use your name. Because you are exploiting your goodwill, quote unquote, that income is subject to unrelated business income tax. And then I've just had the Treasury reg there for you to look at, because everyone wants to read a Treasury regulation now and then. So we've looked at substantially related. Now let's look at trade or business. Trade or business is generally an activity engaged in for the primary purpose of generating income or profit. This profit motive test is often applied in determining whether an exempt organization is engaged in a trade or business for purposes of the unrelated business tax. So you have to ask yourself, is this activity being run like a business Does it have regular hours? Does it have inventory? Is someone keeping the books? Are there employees? All of the things that make an activity look like a trade or business. Conversely, is it being run occasionally when the volunteer shows up and the inventory is kind of in a closet in a box somewhere and somebody buys something once in a while? So you can see the difference between something that's run like a business and something that's more of a little project on the side. One of the items to look at within the trade or business context is the fragmentation of integrated businesses. And the IRS has come up with this term fragment, and what it means is that you take a particular business activity and separate it into its component parts. Some of those parts will be taxed as unrelated business income, and some of them will be exempt. Best example of this is a museum gift shop. And in the resources that we're going to put up with this webinar on our website, I've included a couple of revenue rulings regarding gift shops, so that'll be handy information as well. So in our example, we're going to use the American Folk Art Museum, which is right out of the regs. This museum operates a gift shop. It offers merchandise for sale to the general public, so anyone can come in and buy the merchandise. The items sold in the gift shop include reproductions of the artwork that are in the museum, some wood and ceramic copies of some of the art objects also in the museum, some books related to the development of American art, and some other souvenir items related to San Francisco. So you got pictures of the bridge and umbrellas with, San Francisco written on it, and scarves with Transamerica building, all the little and the New Bay Bridge. We got to have something with the New Bay Bridge on it. The sale of the reproductions, the copies, and the books pertaining to the museum's collections furthers the museum's purpose. So that revenue is going to be exempt from income tax because it's related to the museum's exempt purpose. The sale of the other souvenir items or items that aren't souvenirs but aren't related does not further the museum's exempt purpose, so those sales are going to be unrelated and subject to the income tax because that part of the gift shop is just like any other souvenir shop. Commerciality. You will see this written about more and more because it's an evolving area, it's an evolving concept, and it's kind of backing up from the business and taking the 50,000-foot view. And you ask yourself, is the activity being operated in a commercial manner? And as a result, should it be subject to UBI? Where you need to be careful with using this is that the IRS currently is going back and forth on the result of these analyses. So in some private letter rulings, you'll see one outcome, and in similar private letter rulings, you'll see another outcome. So for right now, try to build your argument using some other basis. And occasional sales, that's just another way to say, is my organization being run like a trade or business, or again, is somebody come in once in a while and buy something out of the box in the closet. Our third prong, regularly carried on. What does it mean to be engaged in an activity that is regularly carried on? It's important to look at the normal time span of the activities when you're trying to decide if something is regular. The easiest example of this is a Christmas tree lot. Now, you're only going to be engaged in the sale of Christmas trees once a year. And you would think, well, that's not regular. But in fact, it is, because everyone is only engaged in the sale of Christmas trees once a year. So you look at the normal time span of the activities and you compare your involvement, and then you say, gosh, is my involvement regular with regard to the normal time span of that activity? Intermittent activities. These are difficult and they require a case-by-case analysis because sometimes these will be regular, sometimes they won't meet the criteria for regular carried on. So if you are engaged in intermittent activities, I think what we want to share with you today is you need to do an analysis and not depend on a general rule. And finally, one-time events. Mostly this arises in the context of fundraisers, galas, auctions, dances, walks, dances. Did I already say dances? I already said dances. Generally, these are not going to be regularly carried on, so they're going to be excluded. But again, watch out for the normal time span. So those are our three prongs that we must have in order to have unrelated business income. I want to depart from that for just a second and touch on travel and tour activities, because this is something that's really picking up out there. There are examples set forth in the regulations addressing travel tours, and they provide tremendous insight into when the IRS considers these travel tours to be substantially related to an organization's exempt purpose. And then conversely, you can say, well, if that's what they consider related, then if it doesn't meet that criteria, then it may very well be unrelated. Part of the resources that we have that we're going to post on our website are the Treasury Reg examples, and they're written in very readable English, and you'll be able to say, gosh, is my tour structured like one of these examples, or is my tour structured differently? One of the things that the IRS focuses on to determine if a travel tour is substantially related, and they wrote this it's an unpublished technical advice memorandum, but it's being used nevertheless. They look for a formal education program or some kind of plan for contacting and meeting with folks who can deliver some educational content during the tour. And they also look at the time involved. If you have an hour lecture every morning on your visit to Tuscany, that's probably not going to meet the criteria for having the whole trip be considered related. However, if that lecture time is expanded somewhere between 1 hour and all of the hours, you're going to cross that line into related. So you need to do a case-by-case analysis on this. There are exceptions given to us statutorily. So Congress has said, we need to have some exceptions here. Some of these have come about through lobbying, and some just because they make sense. The common exceptions, and you see them up there on the slide, the volunteer exception, the convenience exception, donations exception, all of those. We're not going to go through the detail today because we have a little bit of a time constraint, but if all of your unrelated activity is run by volunteers, you might have an exception to the UBI treatment. There's an exception treatment for convenience that Barbara's going to talk about. Also, a donation exception that applies to certain organizations, and then you'll see the others there: sponsorship, mailing list, trade show, bingo, etc. So if something you're doing falls into one of those organizations, just be aware it needs to be something to look at. Additional modifications, these are items that most organizations have, and Congress has said, yes, these types of income are indeed unrelated, right? Because you can say to yourself, but is the earning of dividends my exempt purpose? The answer would be no. You're not ever going to be exempt to earn dividends. But Congress has recognized that these are items of income that are important to every organization, so they have statutorily excluded them. So dividends, interest, annuities, royalties, capital gains, and rents, but watch out for rents because this is a very complicated area. And because it's so complicated, we're going to talk about it a little bit. Exceptions to the rental exclusion. If you have excessive personal property rented with your real property, that can throw you into a UBI situation. If rent is determined by income or profits, that can throw you into a UBI situation. So let's say you have a museum and you have a third party running the cafe. If that third party pays you a flat fee, great, because that's not being determined by the income or profits of the cafe. Or if that restaurant pays you on their gross, that's still fine. And rental agreements are designed that way a lot. However, the minute that your rental payment from the third party is based upon their income or profits, it's as if you are in the business with them. You share in their success or failure. So you cease to be a landlord, and all of a sudden you're in the restaurant business. So watch out for structuring your rental contracts. Also, if you render too many services, then again, you're less like a landlord and you're more like a service provider. If you are renting personal property with real property, sometimes it's a good idea to separate out those leases so that all of the rental income is not tainted. So what to take away from this line item is to say, oh, if I'm renting real and personal property, let me delve into this a little bit and find out how to structure my contracts. And then our famous UBI from rental income from debt financed property, and then income from debt financed property in general. If you recall from way back at the beginning when I started, there was talk about exempt organizations borrowing money and buying real property. Well, exempt organizations, if they were allowed to borrow money, buy property, and then rent out that property, would have a tremendous advantage over the folks that are out there trying to make a living from having residential and commercial rentals. So Congress said no. If you're going to borrow money and then buy property and rent it out, to the extent that your property is debt financed, you're going to pay unrelated business income tax on that revenue. The same applies if you buy securities on margin. So if you borrow money to buy stock and then you earn dividends from those stocks, a portion of those dividends, although generally accepted, will be thrown back into the UBI category. Because the rental exclusion is so complicated, we've designed this little decision tree for determining if rental income from debt-financed real estate is going to be subject to UBI. You can see from this tree that this is a very complicated question. And you'll see, does CHM, our Community History Museum, does it have UBI from rental? And start at the top and just follow it down, and hopefully that will help you. And certainly we're here to help with that question. It's probably a little bit small on your screen, but it prints out well, and you can read the whole thing. Which brings us to polling question number 3. Dennett?
Thank you, Lynn. Okay, so this third polling question reads, statutory modifications and exceptions from the definition of unrelated business income generally include but are not limited to. And you have your selections there, and I'm going to read the selections because we couldn't fit everything for the different selections here, so I'm going to read those to you. A is interest and dividend income. B, royalties. C, activities for convenience of members, students, patients, or employees of 501c3 organizations. D, only A and C. And E, all of the above. So those are your selections. Take a look at those and select your answer. And if you have questions, do enter them in the chat box. We see a lot of questions coming up, so this is great, and we'll get to those as time permits at the end of the webinar. If we can't get to those questions, do know that our presenters will get back to you as soon as they can to address your questions directly. And we'll give you a few more seconds here. Close the polls in 5, 4, 3, 2, 1, and I will hand it back over to Lynn.
Thanks, Danette. Well, this is certainly a good group today. Thank you all so much. This is it's sort of amazing. Like I said, that we're going to have to step this up and be a little more advanced to keep up with our audience. So Barbara, I think you're going to talk to us about advertising and sponsorships and royalties.
Sounds good. Thanks, Lynn. So based on our high-level audience out there, we're going to drill down and look at some topics that are areas that we've kind of chosen that come up quite frequently. We'll look at those areas in more depth here. So first, advertising. So as we know, advertising is generally unrelated business income. Good question. I see some questions coming through on sponsorships and advertising, so hopefully I'll be able to address those, and if not, we'll pick those up in the question section. But what is advertising? That's a good place to start. And I like what Lynn said as far as a lot of terms being defined as what they're not. So on this one, I tried to flip it around and come up with a definition of what it is. And fortunately, there are regulations that finally describe what advertising could be. And let me give you some examples. So advertising can be signs or messages identifying products or services that contain qualitative or comparative language, that provide price information or other indications of savings or value. It can include an endorsement or an inducement to purchase, sell, or use the products or services. So as an example, the statement, Tammy's oatmeal cookies are the best west of the Mississippi. That's a qualitative statement and doesn't look like an endorsement, but is an example of an advertisement.
Although it's true.
It's true, that's right. We're not arguing that, that's true. But we've already learned that there can be exceptions. So as Lynn pointed out, there's a three-pronged test to determine whether you have unrelated business income. So are there any exceptions when it comes to advertising? So what if the advertising activity is not regularly carried on? Well, that could be an exception. And we run into that, for example, private schools, they might have a little bit of advertising in their music program that they hand out in the evening, and that could meet the not regularly carried on exception. Let me give you another example. What if the advertising activity is substantially related to an organization's exempt purpose? Could that happen? Well, there was a U.S. Supreme Court case called American College of Physicians, and in that case the court implied the possibility that advertising revenue could be actually related to an organization's tax-exempt function. The IRS, though, continues to kind of challenge this position, so that's something, if it's pertinent, it needs to be looked at very closely. Could you have advertising activity that's conducted substantially by volunteers? Yes, and that could be an exception to otherwise characterizing advertising income as UBI. So planning can be done to recharacterize what could otherwise be UBI in certain cases. For example, and this is something we run into, particularly in the area of performing arts, in certain circumstances, the publishing rights of a periodical can be transferred to a publisher in exchange for a royalty. So we see this within certain performing art associations where they will actually outsource the publishing of their programs that they hand out, before their concerts or plays or whatever. And so, what's happening here? Well, those arrangements are generally worked out so that the performing arts organization receives a royalty. We'll get into that a little bit more in a minute, which is generally exempt from UBI, versus receiving directly advertising revenue, which would be UBI. So there are a lot of planning considerations here. In that situation, though, in that example, you have to exercise caution, because if the organization has too much control over that publication or that program, then you could run afoul of the exception. So this leads to qualified sponsorships. This part of the UBI landscape has really evolved over the years. In 1993, proposed regulations were issued addressing the difference between what they call simple donor acknowledgments and actual advertising. So it was good to get some insight there. And then a few years later in '97, a code section was added, 513 little I, providing for an actual exemption from UBI for what we call qualified sponsorship payments. So keep that in mind. We're going to be talking about what qualified sponsorship payments are. So it's not uncommon for a business to sponsor a charitable event. This organization, that particular payment to the exempt organization is not unrelated business income if it meets, again, the definition of qualified sponsorship payment. This is defined as a payment. It's important to note that that could be money, it could be property, it could be services by the sponsor without an arrangement or expectation that the sponsor will receive any substantial benefit. So they're kind of given that payment out of the goodness of their heart, for the most part. So in other words, the sponsor cannot receive advertising. That would be something of value. It can't receive an exclusive provider arrangement, goods, facilities, services, or other privileges. If the exempt organization just acknowledges the sponsor's name, presents its logo or product lines, that should be okay. That's not deemed to be an advertisement or a substantial return benefit. There is a de minimis rule, and that is if you look at the agreement and if the benefits that the sponsor is actually getting are valued at less than, at no more than 2% of the total amount of the payment, then the substantial benefit is ignored. If the benefit exceeds that amount, then you'll need to carve out the value of that, include that in your unrelated business income calculation. I think one caution here is when you're entering into these agreements, make sure that the drafts are reviewed. If we work with you, run it by one of us, because what we find is that if they're not reviewed, sometimes they're just kind of muddy and they're unclear, and why not prepare a document that's clear and straightforward, and if there is any return benefit, that it be identified and quantified so that it's clear and concise. So that's just a tip for you. And on a side note, this is a little different area, but some of you might be thinking sponsorships. Okay, I'm a 501c3. How does that affect my public charity calculation? And so a qualified sponsorship payment is actually part of your public support, enters into that calculation. And then on the other side, with respect to the business, generally, to be honest with you, they probably deduct it as a trade or business expense. So it's kind of best of both worlds. So on the next slide are a few points about royalties. And again, there's an exception for royalties, a statutory exception. An example is a payment, it's generally a payment for the use of an intangible right, such as a trademark, trade name, or copyright. Again, you have to be careful with respect to those agreements. Good idea that the draft be reviewed, because if the exempt organization provides services in connection with that royalty payment, it can cause that payment to be taxable as UBI. So in today's modern landscape, several issues have been challenged and finally addressed. I'm just going to mention a couple of those. Revenue from mailing lists, we run into that a lot. There are a couple of favorable cases, including Sierra Club and Common Cause versus Commissioner. Those have been viewed as royalties, again, exempt from UBI. What about affinity cards? This has gotten kicked around with the IRS and through the court system. And the good news is that the IRS is no longer likely to challenge such arrangements, since they generally fall under the definition of royalty. Just a couple of quick words on other considerations in light of internet usage now. We hope that the IRS will issue more guidance in that area. They issued some guidance back in 2010, and of course there's been a lot of private letter rulings and things since then, but we're still looking for guidance. But for example, Lynn talked about the three-pronged test, and one of them is that you're regularly carrying on a business, usually refers to the time spent. Well, does that also refer to an activity on the internet? I mean, in other words, the website is available 24 hours a day. Is that how we judge how much time is spent, or is it judged by the actual services rendered? So again, we expect clarification in that area. I did, before I turn this over to Tammy, want to point out, give an example, a couple of other examples that relate to this day and age in the internet. There's one example in the regulations, and it basically refers to a symphony that has so a sponsor's internet address actually appears on the symphony's website in the form of a hyperlink to the sponsor's website. The symphony's website does not promote the sponsor or advertise its products. So the regulations say that this does not constitute substantial return benefit, so it's not advertising. So that lends some clarity. And then in the next example in the regulation, it's very similar, but it says on that website the organization actually endorses the use of the sponsor's products, and that's stepping over the line, and that would be revenue related to that would be characterized as unrelated business income. So let's take a look at the next, this next one's kind of fun. I need to study this for just a couple seconds. It relates to our next polling question. So take a look at it, and probably all kinds of things going on in your mind right now. And with that, I'll turn the question over to Danette.
Okay, thank you, Barbara. We'll give you guys just a few more seconds here to take a look at this image because the question is related to it. So study it closely. Okay, so we'll go on to the question right now. So the question is, are the sponsors' banners in that picture that you just saw advertising? Yes, no, not sure. So try to remember what that image looked like and make your selection. Again, we need your participation in these polling questions. If you are going to be eligible for CE, you need to at least participate or respond to at least 75% of these questions. We'll give you guys a few more seconds here before we close the polls. We'll close here in 5, 4, 3, 2, 1. And I'll let Barbara.
Okay, thanks, Danette. And that was not a trick question. It was really specific, though. Is it advertising with respect to unrelated business income considerations? So it was the logo for Rolex and the logo for Corvette, I believe. Correct me if I'm wrong. And so those were merely logos. There was no endorsement. This happened to be at a charitable event I went to a couple of weeks ago. And I just happened to shoot a picture of this banner knowing that we were given this presentation. So there's no endorsement, no qualitative comments about it. I think any suggestion of quality is probably in your head. It's not, there's no language that would lend itself to that. So this is an example of something that's okay. So they had a couple of good sponsors here. They were acknowledged, but there was no, we can't characterize the benefit that they received. We cannot characterize it as actually advertising, which is good. That's the answer we wanted. Alrighty, and then just a couple words on investments. With all this knowledge that Lynn gave us and Tammy will fill us in on towards the end here, we use all of that to analyze investments in partnerships. It's no different. The items from the partnership flow through, retain the same character, so you might have interest dividends, you might have rent from a rental property. Everything retains its character, and the thought process is the same in doing the analysis. Technically, the K-1 should have information that has calculated what the unrelated business income is, but often that's not done. A lot of times the general partner doesn't realize that an investor is actually a nonprofit entity, so you cannot necessarily rely on that. Investments in S corporations, that's easy. All income is unrelated business income, so you don't really, for that reason, don't see too many exempt organizations making that type of investment, and also the sale from S corporation stock is just automatically unrelated business income. Alrighty, so Tammy, I'm going to let you fill us in on considerations by different organizational types.
So thank you, Barbara and Lynn. Lots of information has been covered already, and we are now nearing the freeway exit on our road trip. Let's just look at a few different types of organizations in general. Educational organizations can engage in activities that are exempt functions that facilitate or otherwise support the accomplishment of the institution's educational purpose and major functions, such as student housing, operation of a bookstore, food service or a cafeteria, laundry facility in a college dormitory would normally not be considered to be UBI. Healthcare providers and hospitals that generate revenue from patients through Medicare, Medicaid, insurance, etc. is not UBI. Pharmacy stores at the healthcare provider's office or at a hospital that sells medical supplies and drugs for the convenience of the patient is normally not UBI. Tax-exempt museums that maintain collections and make them accessible to the general public can consider their admission fees to not be UBI. In conjunction with admissions, restaurants or coffee shops inside a museum for the convenience of patrons would normally not be considered to be UBI. Business leagues that provide services to its members in exchange for dues is not UBI. Dues meaning payment to be recognized as a member of the organization that normally has a $100 cap. So for example, farmers who pay to be part of an agricultural organization would normally not be UBI if under that $100 cap. For each instance, you should look at the variables, the 3 criteria previously mentioned by Lynn, and if needed, consult your tax preparer to determine if UBI. So how do you report UBI? Federal Form 990T needs to be filed if gross income is $1,000 or more. Depending on how you formed, you would pay tax on net income on Form 990T at either the corporate or trust regular tax rates. California Form 109 has similar reporting requirements to Federal Form 990T. However, the tax is 8.84% of net income for unrelated business income. And depending where you've registered and solicit funds, you may want to look at other state UBI filing requirements. And regardless of completing Form 990T, the core form, which is Form 990, Part 8, which is actually the picture that we have on the screen, there's a separate column to report UBI in column C. If you're reporting UBI and you have a loss, the appropriate attachments and forms will need to be filed for net operating losses. And depending on whether you owe tax or not, you may need to pay quarterly estimated tax payments. So we want to make sure that you are still in the driving seat with us. So we will now ask our last polling question.
Thanks, Tammy. Okay, so this last polling question reads, on what form would you report your federal unrelated business income? You have your selections there. Take a look at those. And we appreciate hearing from everyone, even if you're not interested in CE. And if you have additional questions for us, please do type those in the box, and we'll get to those if time permits. I'll give you a few more seconds here. Okay, we'll close the polls in 5, 4, 3, 2, 1. Okay, and I'll hand it back over to Tammy.
So we do have a really smart group today. The correct answer was C, Form 990T, that's the federal form, and 98% of you got that right. So areas of focus for the IRS has been the college and university examination study, which came out earlier this year in May. The study identified a 90% non-compliance rate for colleges and universities, and it identified two primary ways that UBI was regularly misreported. The first was organizations claiming losses from activities that did not qualify as a trade or business because the organization did not engage in the activity with the intent to make a profit. The second was organizations misallocating expenses to offset UBI that were not directly connected to the UBI activity. Also, as a result of the examination, the IRS disallowed miscalculated or unsubstantiated net operating losses used to reduce UBI. And the IRS reclassified a variety of activities, including, among others, those relating to advertising, fitness recreation centers, golf courses, sports camps, facility rentals, and arenas. The IRS website does have the findings from this examination on their website, and it is a very interesting read. The IRS has also been concerned that losses from one UBI activity is being used to offset another activity. This would apply to organizations with multiple UBI activity. Another place the IRS looks to make sure that the UBI is properly reported is the Form 990, which is the core form trigger questions, and whether you're reporting 990T correctly or not. So we do have on the screen there for you two areas from the core form that relate to whether Form 990T is reported or not. The first is from page 1, part 1, lines 7A and 7B, and the second box is page 5, part 5, line 3. These questions should be answered appropriately whether Form 990T is filed or not. On the next slide, we have some resources for you that might be helpful when you're examining UBI. Your tax or legal advisor, the IRS pub on UBI, the Federal Form 990T and California Form 109 instructions, the IRS website on UBI, the book by Bruce Hopkins, The Tax Law of Tax-Exempt Organizations, and as Lynn previously mentioned, we will also have available on our website in 3 to 5 business days a few revenue rulings regarding travel tours, fragmentation, and gift shops, and a couple cases related to advertising. So in conclusion, after today's webinar, we hope that we have met our learning objectives to review the statutory framework and review recent case law and rulings in this area affecting your organizations, provide tools to help you navigate through the changing landscape of unrelated business income, discover how to structure certain transactions to minimize or avoid exposure to the tax of UBI, clarify how UBI income is reported and how the tax is calculated. We hope you have enjoyed this time with us and look forward to having you join us in future webinars.
Thanks, Tammy. Looks like we have time to answer one of the questions that's come from our listening audience. So the question is, how does a hybrid lease agreement get treated where the rent is a combination of a fixed amount and a % of gross income? All right. Assuming that there's no debt financing on the property. Okay, that's a very important point. So not a debt financed property. If the rent is structured as a fixed amount plus a percentage of gross, that will not result in unrelated business income because it's a percentage of gross, not a percentage of net. If you have debt financing, then the debt financing will throw a portion of the rent back into UBI. So you have to watch out for that coming from two different directions.
Great. Thank you, Lynn, Barbara, and Tammy for your time. On your screen here is the contact information for our presenters. If we did not get to your question, please do know that our presenters will get back to you and address your questions directly. As a reminder, your CE certificate, if you were interested in this webinar for CE credit, you will receive your certificate. It will be emailed to you within 3 business days. You will also receive an email with a link to this webinar recording and the slides and all the additional information that our presenters will make available regarding the information they gave today. So thank you everyone for your participation today, and we look forward to your participation in future webinars. Have a good day.